if you own gold and silver, if that's the money you save, then everything is going to be cheaper. The price of everything that you need to buy will be less expensive if you have gold and silver to pay for it. If the U.S. economy was so great, gold would not be $4,600 an ounce, right? Silver would not be $90 an ounce if we had a strong economy, right? We wouldn't be running these massive deficits. Buy some gold and silver, because this rally is not over. This is the beginning. This is not the end. Don't wait for Monday. In fact, this Monday is Martin Luther King Day. So if you're going to wait for regular trading to resume, you're waiting for Tuesday. Don't wait. I think we're going to have another huge move up on Sunday night, Monday, Tuesday.
In this video, renowned economist and market commentator Peter Schiff explains why rising gold and silver prices are not a sign of economic strength, but a warning signal. He argues that if the U.S. economy were truly strong, gold would not be trading near $4,600 an ounce, and silver would not be approaching $90. These prices reflect deep structural problems, massive deficits, and ongoing currency debasement. The core message is simple. When you save in real money like gold and silver, everything else becomes cheaper over time. As fiat currencies lose purchasing power, tangible monetary assets preserve and even enhance wealth. This rally in precious metals is not viewed as a late-stage blow-off, but as the early phase of a much larger repricing cycle. The discussion stresses urgency. Waiting for normal market hours may mean missing critical moves as global trading resumes. With momentum building and confidence in paper assets eroding, the shift into gold and silver is accelerating. According to this outlook, the move higher is just beginning, not ending, and hesitation could prove costly. If you found this helpful, like, share, and subscribe to The Metal Bar, turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
Now, silver's been a lot more volatile than gold all week, but the important point is that the volatility is taking place at these very high prices. And this is just another consolidation of this big breakout. So if you're thinking about looking for a big pullback to buy silver, think again. The opportunity to buy $50 silver is long gone. Right? And you're lucky if you could buy $70 silver, but I wouldn't even wait for that because I think the supplies of silver are going to start to run low and the premiums are going to really start to blow out, so that even if silver goes down, the price of silver coins and bars may still go up. And in fact, most of the move on the week, this week, happened on Monday. But why are these silver stocks getting hit so hard when silver is $90 an ounce? None of this makes sense. Yes, gold and silver stocks have tripled along with the price of gold and silver, but their profits are going to go up a lot more than triple. These stocks should be much, much higher. The reason they're not is because Wall Street still doesn't understand what's going on. And remember, there are really two different buyers. Wall Street, where they buy stocks, they're not buying the physical metals. They're looking at stocks. And they don't understand why gold and silver are going up. And they don't expect the prices to keep going up. In fact, they don't expect the prices to stay up. That's why they've been so reluctant to bid up mining stocks and adjust their future earnings forecasts for higher gold and silver prices. In fact, they're still assuming that gold prices in the future are a lot closer to where they were in the past than where they are right now. Now, indication that maybe that's changing was the action today, because even though gold and silver finished down on the day, most of the stocks recovered all those morning losses and finished positive on the day. They all didn't finish positive, but many of the stocks that I own not only finished positive on the day, but made new multi-year highs on the day, despite gold and silver being down. And what I've been saying is that these sell-offs are irrelevant to the value of these gold mining companies. Gold could go to 3,000 and they'd still be cheap. So what difference does it make if it's 4,600 or 4,500 or 4,300? Doesn't make any difference at all. Gold stocks should be going up every day at this point, regardless of the short-term fluctuation in the price of gold that has no bearing on what these companies are going to earn now or in the future, and probably even more so with these silver miners, given how much the price of silver has gone up. What happened with gold, what's happening now, I think, is forecasting a much bigger monetary crisis that may hit later in the year or maybe even next year, but in the dollar, in the bond market. So gold is reacting first, just like subprime reacted first in 2007. You saw the broader crisis hit a year later. Same thing's going to happen now, except it's not a mortgage credit that is the problem. It is government credit. It is sovereign debt. It is the debt of the United States. It's not a mortgage crisis. It's a U.S. Treasury crisis. That's what's coming, and a U.S. dollar crisis. Gold and silver are your early warning signs. First it was gold, and now it's silver, and of course platinum. The whole precious metals complex is flashing that the dollar is in trouble, that the U.S. bond market is in trouble. And what Trump is doing is playing a big role in that. But we also have some news that came out this week that I didn't have on Monday when I did my main podcast. So I want to get into this news that is also bullish for gold, and that is inflation and the inflation numbers. So we got the official CPI numbers came out on Tuesday, and the media initially hyped this up as if it was good news, like, oh, see, inflation is going away, right? But here are the actual numbers. So the PPI, and these are December numbers. So the month increase in consumer prices was 0.3. The prior month was 0.2. So it got worse. And if you annualize 0.3, you're looking like 4% inflation. That's double the Fed's 2% target. The Fed is cutting rates. They're talking about rate cuts, and inflation is twice what they claim they want it to be. They should be hiking rates, not cutting rates. And how is this good? Then the year-over-year increase in the CPI, which was forecast to be 2.6, came out at 2.7. So it's worse. It's worse than they thought, right? Yet they're still talking about rate cuts.
In this video, we break down why silver's extreme volatility is not a warning sign, but confirmation that a major breakout phase is underway. Despite sharp daily swings, silver continues to consolidate at historically high prices, signaling strength rather than weakness. The era of cheap silver is over. Waiting for a return to $50 silver may mean missing the move entirely, as physical supply constraints and rising premiums threaten to override spot price pullbacks. The discussion explains why mining stocks appear disconnected from metal prices and why Wall Street still doesn't grasp what's unfolding. Equity. Analysts continue to model future gold and silver prices based on outdated assumptions, underestimating earnings power in a structurally higher price environment. Recent price action suggests that disconnect may finally be starting to close. More importantly, gold and silver are framed as early warning indicators of a deeper monetary problem. Just as subprime mortgages cracked before the 2008 crisis, precious metals are now reacting ahead of what may become a U.S. Treasury and dollar crisis. Inflation data reinforces this concern, with consumer prices accelerating even as policymakers discuss rate cuts, an outcome that historically fuels further currency debasement. Gold moved first, silver followed. Together, the precious metals complex is flashing stress signals across the bond market and the dollar itself. These moves are not speculative, they are diagnostic. Now let's get into the interview.
If the U.S. economy was so great, gold would not be $4,600 an ounce, right? Silver would not be $90 an ounce if we had a strong economy, right? We wouldn't be running these massive deficits if we had a strong economy. You know, people were making a big deal about the trade deficit finally took a big drop, and they want to credit Donald Trump for this big drop in the trade deficit and say, hey, you know, maybe it's the tariffs. It's not. The main reason that the trade deficit went down last month is because a boom in gold exports. We exported a lot of gold, right? We didn't manufacture that, right? That's our gold that got exported, and that's 90% of the improvement in the trade deficit for the month was all the gold that left the country. That's not a good sign. You know, our imports were down, but our exports weren't really up that much. And the main reason our imports were down is because they're more expensive, so we can't afford to buy them. In fact, if you look at China's numbers, China's exports to the U.S. were down, I think, 20 or 30%. Yet they posted all-time record high trade surplus. How is that? They're selling less to America, but more to the whole world, right? So what they didn't sell to us, they sold to the Europeans. They sold to the South Americans. They sold to other Asian consumers. So our loss was their gain. Other consumers got what we could no longer afford. And China didn't miss a beat. In fact, the Chinese yuan was up about 5% last year, closed the year, 2.5-year high, and it's already rising again. And so China is winning the trade war. They're going to win the currency war. The RMB, the Chinese currency, is going to rise substantially against the dollar. And that's a good thing for the Chinese. That means the Chinese are going to be wealthier. They're going to have higher standard of living. You know, we keep talking about the affordability crisis. The cost of living is going up. Well, it's going to get a lot higher, right? Things are going to become a lot less affordable in the United States as the dollars that Americans earn are less valuable.
This discussion brings together some of the clearest warning signs yet that the U.S. economy is far weaker than headline narratives suggest. Record high gold and silver prices are not symbols of prosperity. They are signals of imbalance. If the economy were truly strong, precious metals would not be surging while deficits continue to expand and purchasing power erodes. What's especially alarming is how recent positive economic data is being misinterpreted. A shrinking trade deficit may sound bullish, but when that improvement is driven largely by exporting national gold reserves, it raises serious questions about long-term stability. At the same time, rising import costs reveal a deeper problem. Americans are buying less not by choice, but because affordability is deteriorating. Globally, the picture is even more revealing. While U.S. consumers are priced out, other regions are absorbing the same goods, leaving exporting nations stronger and currencies more resilient. This dynamic accelerates currency divergence and deepens the pressure on the dollar, reinforcing why hard assets continue to reprice higher. Gold and silver are not reacting to hype. They are responding to fundamentals, trade flows, currency shifts, and declining confidence. These metals are reflecting stress in real time, not forecasting growth. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in.